Good afternoon for everyone in Japan, and good time of the day wherever you are in the west or the east of Japan. My name is John Hobster. I'd like to thank you all for attending today's webcast, which is called Transfer Pricing Controversy in Japan. I'm lucky enough to be moderator of this call. I'm the Global Transfer Pricing Leader for EY. I've got several of my colleagues from our Tokyo office joining, and we're going to discuss the current audit environment in Japan and present a couple of case studies to you. However, before we do, we need a few housekeeping items covered off. At the bottom of your audience console, there are multiple application widgets that you can use. If you have any questions during the webcast, please submit them on the Ask a Question widget. We'll try to answer them during the webcast, but we sometimes find that a fuller answer is required or we're running out of time. If that's the case, we'll answer later via email. We do capture all the questions. The deck with today's slides and the biographies of our speakers are available in the resource list widget that looks a bit like a little green folder at the bottom of your screen. You can expand the slide area by clicking on the maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area. Any technical difficulties, please click on the help widget. It's got a question mark icon and it covers technical issues. We'll be making available approximately a few days after this webcast an on-demand version of it, and you can access that using the same audience link that was sent to you earlier. You will receive an email once that's available. And finally, at the end of today's webcast, you'll be presented with a survey to complete, and there'll be a CPE certificate available to download for those that participate in the whole webcast and answer the polling questions. So let's get started with one of the polling questions. But before I do, I'm just going to flash up there who's going to be joining me on the webcast here. It's a privilege to be joined by Pamela Ammerman, Carl Grundl, Yoshiko Sato, and Keith Thomas, all very good, long-standing colleagues and friends of mine from our office in Tokyo. Let's turn to the polling question, and you will need a few seconds to think about this. The question is this: what Asia-Pacific jurisdictions and tax authorities do you consider present the biggest tax risk and or require the most resources from you? So we have a choice. You can answer with more than one if you wish, but Japan, China, India, Korea, Australia, or other. Can you click the ones, please, that you believe represent the biggest tax risk? And we will take a quick look at the results. In just a second. Okay, there you see them. So China shows as the, I was going to say the winner, but it's a doubtful honor to be the winner in response to this question, but closely pursued by Japan and then India. So I don't think that's a particularly surprising response. It does contextualize the fact that some of the newer transfer pricing regimes are also perceived to be some of the most aggressive ones. Japan is not a new one, but it's still up there way into the crowd. So with all of that, I'm going to ask my colleague Pamela to move on and take us through the context of the controversy environment in Japan. Pamela.
Thank you, John. The first chart should be appearing. As you can see from the chart, transfer pricing assessments dropped off significantly in 2008 after the Lehman shock. They have gradually been building back up. We expect that assessments will continue to increase in the near future. One reason is the adoption of formal TP documentation requirements in 2014. Previously, TP documentation was advised but not required. The requirements themselves have not changed, but because they are now required by law, examiners have more leverage when making information requests. Another reason is BEPS. For years, the Japanese tax authorities have requested segmented P&L data for the entire value chain with varying success. But with the advent of BEPS and the drive for more transparency, the Japanese tax authorities have become even more tenacious in seeking this data. As you would expect in the current environment, APA applications have been increasing in the past few years. The numbers briefly decreased in 2011, but we expect more applications going forward. In Asia Pacific, for the last 5 to 10 years, the focus has increasingly been on China, India, and Australia. Because of limited budgets and personnel, Companies have devoted their resources where they perceive they have the greatest tax risk. As Japan does not impose penalties for failure to provide transfer pricing documentation, many companies treat Japan as a low-risk country. However, it is worth keeping in mind that Japan can be a tough audit environment. And because of how TP audits are run, it can be very resource-intensive. Japanese examiners have very broad discretion, and it is not unusual for them to make multiple requests for clarification of data. They also have very stringent requirements. For example, when examining the transfer pricing calculations and supporting documentation such as invoices, examiners expect the numbers to tie down to the yen, and they will spend months making additional requests and asking for more data to get an exact reconciliation. As a result, it is not unusual for examinations to last more than a year. In terms of fact patterns for inbound companies, we often see businesses structured such that there is a regional head of tax. This regional leader often has a corporate tax or accounting background and may have transfer pricing experience, but is not a transfer pricing expert. In Japan, there is usually only a small finance team. The issue that we see is that the regional leader relies on the Japan finance team for local compliance. This is sufficient for corporate tax purposes, but the Japan team often does not have transfer pricing experience. It is not aware of the transfer pricing requirements. We often see situations where the taxpayer has prepared regional or global documentation, but it contains no separate description of the Japanese business, even if we have been told that Japan operates differently from the rest of Asia. For example, we regularly see reports that lack a specific description of Japanese products or services, have no headcount numbers, show no organization chart, and do not provide any transactional information about the related party transactions in Japan. This is despite the fact that all of these items are required under the Japanese transfer pricing regulations. In such a case, the examiner has the authority to set aside the documentation and perform his own fact-finding. It is also common to see benchmarking studies using Asia-Pacific comparable sets with few or no Japanese companies included. This is problematic because the Japanese tax authorities consider Japan to be a unique market, and their position is that only Japanese companies provide a reliable benchmark. If the Japanese examiner does not feel that the result is reasonable, he has the authority to reject the proposed companies and create a more appropriate benchmarking. In that case, the burden is on the taxpayer to show that the result is not reasonable. Given this background, let me turn it back over to you, John.
Thanks, Pamela. I think what you tell us here is it's quite clear that people, taxpayers, particularly inbound ones into Japan, are creating the master file as is envisaged, probably not quite as envisaged, but are creating a fairly consistent global picture, but it's not quite reaching Japanese standards. So let's turn to the audience and ask them what their experience is, and let's just compare that with your opening remarks. And the question here, what type of TP documentation do you currently have prepared? You see the choices here, and you can pick more than one, but I think most people will pick one. Master file and local files for all jurisdictions, master file with regional documentation, master file with some local documentation, master file only, local documentation only, or no documentation. Please click away there, and in just a few seconds I'll pop up the result and see what we have. There we do. So we have actually quite a few there with local documentation only at 40%, tying with master file with some local documentation. And that, I think, is probably not atypical. I'm perhaps a little surprised by the local documentation only, although maybe that suggests, Pamela, that people are responding to some of the challenges that you've highlighted in your opening remarks. So with that, I'd like to move on, and we'll go to our first case study, which is going to be presented by Carl Grindel, a partner in our Japan transfer pricing team. Carl, I think the first one is global versus local documentation.
Thank you, John. So this first case study is based on some real-life audits. Everything that happens in this case study is something that I've seen in at least one audit. Some of these events are more common than others. The company, which I call Acme, has global documentation but has never made a full Japanese transfer pricing report. Now, this is quite common, and Pamela touched on this as well, and of course this was the subject of the polling question. But this is very common for a number of reasons. Many companies have budget constraints, and it's difficult to produce full documentation studies for every jurisdiction. So Japan is sometimes one of the countries that is excluded from the scope of producing full local documentation. Now, many companies also see that Japan has no legal obligation. There's no explicit legal requirement for contemporaneous documentation, and there's also no penalty for failure to have contemporaneous documentation. So what many companies do, and what ACME does in this case study, is just to use their global report, their global transfer pricing report, which categorizes all of the distributor subsidiaries in one section. So there's one generic section covering all the distributors, and which uses regional comparables. So Japan would be tested using Asia-Pacific comparables. So as you can see on the slide, ACME Inc. is a U.S.-based multinational in the consumer health products industry. And their subsidiary, ACME Japan, imports products from related parties for resale in Japan. And the third point is what I just explained with respect to their documentation. So the company becomes the subject of a transfer pricing audit. And one of the first requests from the tax authorities is for their transfer pricing documentation. So ACME Japan submits the relevant sections of the global report. Now, because it's just a generic description of distributor subsidiaries, the examiners realized very quickly that no documentation has been prepared specifically for Japan. So they decide that they need to conduct their own fact-finding, which lasts approximately 10 months. So over that 10-month period, there are 36 meetings, about 15 questionnaires, and the questions go into enormous detail regarding every individual product, every individual transaction. So they ask not only about product resale transactions, but every single intercompany charge, and of course, intangible transactions such as royalties. They also ask a lot of detailed questions about the organization. So they want to see very detailed organization charts, and they want descriptions of what every group and every person in the organization does. They ask for seating charts of the office. They want to know where everyone sits. So the audit becomes very detailed and time-consuming for ACME Japan. The examiners also conduct interviews of various business people, including the marketing head. So ACME Japan's marketing head talks with the examiners and describes the company's various strengths and competitive advantages, and all of the reasons why ACME Japan is so successful and superior to its competitors. They also interview the head of regulatory affairs. So ACME Japan needs to request regulatory approvals to sell their products in Japan from the health ministry. So the head of regulatory affairs admits that without those efforts by ACME Japan, the company cannot sell products in Japan. Just another point I want to add is that throughout this entire process, ACME Japan is handling the audit on their own. So this is the local finance team. They're not transfer pricing specialists. They're not even tax specialists. They haven't yet hired an advisor. And the only direction they get from headquarters is to stick to the story in the documentation. So that's how they're responding to the audit, except the documentation, of course, is quite thin, so it doesn't give them much to go on. Meanwhile, the tax authority is also looking through ACME Japan's press releases, and they see that in a number of press releases, the company stresses how important the Japanese market is to the ACME global organization. It's a very critical market for the company. They also notice, the examiners also notice that there's a factory in Japan. And I put factory in quotes because it turns out it's just a minor packaging facility. They just package and label products for the Japanese market. But the examiners, of course, see factory and think manufacturing. So after 10 months of this very detailed fact-finding, the Japanese tax authority issues a written opinion. And they state that ACME Japan is a full-fledged developer and manufacturer. So, for example, they saw the regulatory function where the company has to gather clinical data. Much of it comes from headquarters, but they have to supplement it with some clinical data from Japan and format it correctly and submit that to the health ministry for approvals. And the tax examiners have decided that that is valuable R&D. of course, the examiners also decided that the factory is a very significant manufacturing operation. The examiners further decide that Acme Japan's transactions should be segmented into 5 groups. So we're not talking about a company-wide test of profitability. They want to segment the business into 5 different segments and test the profit separately. Now, when you do that, unfortunately, some of the segments show losses, even though the company is profitable in the aggregate. So since some of the segments have losses, the examiners decide that the transfer pricing may not be arm's length. So Acme Japan is very surprised when they receive this opinion, and so they very hastily put together a new economic analysis where they look for Japanese comparables because the global documentation was based on regional comparables. So Acme Japan puts together a set of Japanese comparables and they compare it to the company's company-wide profitability. And they show that Acme Japan is actually a little bit more profitable than the comparables. So the Japanese tax authority sees this analysis and they reject it with very little explanation. So they provide a one-page document which says only that they don't really think the comparables are completely comparable. They think the products are a little different and not quite appropriate for the analysis, so they can't accept it. Then the examiners conduct their own preliminary comparables research and they analyze only the money-losing segments of Acme Japan. Remember, they're looking at the company on a segmented basis. And based on that analysis, they calculate tentatively a $150 million income adjustment. So this is a shock to Acme Japan, of course, but it's also a shock to the tax director at Acme headquarters in the U.S., who finally realizes the situation has gotten very bad. So he now needs to scramble to decide how to respond to the examiners, but he also needs to think about FIN 48 and financial reporting requirements. So now he has a whole new set of headaches to deal with, which he had not expected. So Acme Japan also now realizes just how bad the situation has become, and they attempt to correct the tax authority's mistaken impression about the business and the functions and risks in Japan. So they finally submit some written explanations emphasizing that the manufacturing is minor, it's just packaging and labeling, there's no high value added activity there. They explain that the regulatory approvals are not some kind of development intangible, they're just a procedural necessity. It's just a matter of gathering data and formatting it and submitting it, which is a rather routine activity that almost anyone could do. So this time it's the tax authority's turn to at least pretend to be shocked. So they react with shock and they say, why didn't you tell us these things before? This is not at all consistent with the impression we had from all of the interviews and fact-finding we did for the last 10 months. So they decide, since this is a completely different story, now we have to redo the fact-finding to check what's really going on and find out what's really the truth. So they conduct, they ask 40 more questions and conduct 6 more interviews with the business people. Now, the process is aggravated by the fact that Japan also has regular personnel rotations. So some of the examiners, by this point, have actually rotated out of their position and been replaced by some other examiners. So the company now has to re-educate the new examiners who are not completely caught up on the case, which ends up taking even more time. However, throughout this new fact-finding process, the Japanese tax authority, of course, realizes that they've already issued a written opinion. So the attitude they bring to the process is really one of just looking for evidence to confirm the assertions they've already made. So unfortunately, the taxpayer is unable to convince them that their position is wrong. And after several more months of discussion, there is a very large tax assessment issued by the tax authority for, surprise, $150 million after which the company requests a mutual agreement procedure with the other tax authority. And that lasts about 2 or 3 years and consumes a great deal of additional time. So this case study illustrates what can happen when there is not a specific full local documentation study in Japan. And also when the local finance team is not sufficiently prepared for the transfer pricing audit. So the next slide, so this is the last slide in the first case study. And this slide is just a list of the elements of transfer pricing documentation that are included in the Japanese guidelines on transfer pricing documentation. So you may recall that at the beginning, both Pamela and I said that Japanese transfer pricing documentation is not legally required in Japan. There's no legal obligation. So the way the rules are phrased is they say that in a tax audit, we will request these documents, and we expect you to submit them without delay. Now, if you look at the list itself, there's nothing particularly surprising about it. These are all fairly standard items that you would find in a transfer pricing report in most areas of the world, except possibly for number 6. Number 6 is about financial data, including financial data of the overseas related party segmented for its transactions with Japan. Now, most companies do not include that in their Japanese documentation because their financial systems don't produce that information, that type of segmentation. And it would be very difficult to try to estimate that. Now, in an audit, the examiners may request that type of information, and then the company would need to decide how to respond based on what kind of information is available, how quickly can they produce an estimation of the related parties' segmented financials, and that kind of thing. So that's something we would generally judge on a case-by-case basis. Now, another thing, so this case study so far has illustrated some of the things that can happen when the Japanese documentation is either inadequate or when it doesn't exist. There's another thing that can happen, which I haven't yet mentioned, which is comes from a strange quirk in the Japanese tax law, where if you don't answer the tax authorities' questions in a timely manner, they can impose what they call presumptive taxation. What that means is that if you don't answer their questions promptly, they are authorized under the law to go and conduct their own analysis, which in some cases could include the use of secret comparables. So they could go to third-party companies and obtain from those companies transactional profit data for use as comparables against the taxpayer. And they can even make a tax assessment based on those comparables. And the tax authority used to do this quite often back in the 1990s and the early 2000s. They were criticized very heavily by various people, of course, taxpayers, other tax authorities, tax practitioners. So in recent years, we don't see the Japanese tax authority doing this very much. We don't see them using secret comparables very much. But that provision of the law still exists. We still see them making threats during audits to impose presumptive taxation if the taxpayer does not cooperate. So it's something that's still there and that they still use as leverage during audits. So getting back to the list on this slide, when producing documentation for Japan, it's very important that these items are explained from a Japanese perspective. So, for example, you wouldn't want your functional analysis just to be a generic description of distributor subsidiaries. It needs to contain factual information about Japan and what really goes on in Japan. And I'll just conclude by saying, I guess kind of repeating the point that Pamela and I have made already, which is that since Japan doesn't have penalties, many people think that they don't need strong or very full local documentation. But this case study shows what can happen when you don't have local documentation. So with that, I think I will turn it back over to John.
Thank you, Carl. We've seen these fact patterns occur numerous times, you and I, over the last 15 years, I suppose. And I think what I learned from it is that a modest amount of incremental effort to localize and present the local perspective accurately at the start, it feels like a pain to the global organizations who are trying to keep consistency and to keep scope narrow enough to make sure that they don't have many departures from the standard script. But here, the case study illustrates that a modest departure from the standard script at the start might have very much shortened and minimized the pain felt by the taxpayer. So thank you for that. I think it's a very illustrative and very fair representation of what tends to go on, certainly in my experience. So with all of that, we don't want to make everyone too depressed. Let's move to the next couple of case studies where my colleague Yoshiko Sato is going to walk us through some different scenarios in Yoshiko?
Thank you, John. I go over case study 2, donation, downward TP adjustment under TNMM. We have seen the following fact pattern many times in corporate examinations. Applying transactional net margin method, TNMM, the Japanese taxpayer makes a downward transfer pricing lump sum adjustment, TP adjustment. However, there is no intercompany agreement in place between the Japanese taxpayer and its foreign affiliate, or there is agreement, but it does not contain a provision allowing for lump sum adjustment, or the taxpayer has no transfer pricing policy and the adjustment amounts were computed inconsistently from year to year. The result is the Japanese tax authorities, JTA, tried to impose donation treatment, asserting that a donation has been made to a foreign affiliate. The JTA has the authority to disallow a deduction as a donation under the Japanese domestic law. Nevertheless, even in cases like the above, where it is clear that the counterparty is in a foreign country and that a transfer pricing adjustment is intended, the JTA imposed donation treatment. A downward TP adjustment under the TNMM could be disallowed if no sufficient documentation is made available, i.e. agreement, transfer pricing documentation, and transfer pricing policy. Under this case study 2, the factual pattern is the following. U.S. parent is IP owner, and U.S. parents grant technologies to Japanese subsidiaries. In turn, Japanese subsidiary, which is distributor, pays royalties. And in 2009, Japanese subsidiaries' operating result fall above the interquartile range. Therefore, as a result, Japanese subsidiary made transfer pricing adjustment payment to the U.S. parent. Chronological events are following. In May 2009, the U.S. parent sent an email to the Japanese subsidiary explaining that the tax department engaged a U.S. transfer pricing advisor to conduct a transfer pricing study. As an initial step in this process, the U.S. advisor undertook functional interviews with the Japanese subsidiary. November 2009, the U.S. parent asked the Japanese subsidiary by mail to provide their forecast for 2009. December 2009, the U.S. parent communicated by mail the draft interquartile range, a work in progress. This range had been prepared by U.S. transfer pricing advisor. The U.S. parent also emailed information about the necessary journal entry for the downward transfer pricing adjustment. The Japanese subsidiary responded that in the absence of a clause in the contract allowing for lump sum transfer pricing adjustment, and unless transfer pricing documentation was made available to a subsidiary, it would likely be subject to a donation treatment in Japan. The U.S. parent insisted that a downward adjustment should be made to manage transfer pricing exposures in the U.S. The Japanese subsidiary made a transfer pricing adjustment for book purposes in December 2009. 2011, the Tokyo Regional Taxation Bureau began a corporate examination of the Japanese subsidiary in 2011. The examiners argue that the transfer pricing adjustment was made without reasonable grounds. There was no executed intercompany agreement that stipulated a transfer pricing adjustment, and the U.S. parent did not have any transfer pricing documentation supporting the transaction, i.e., the U.S. transfer pricing advisor had not yet delivered the draft transfer pricing documentation to the U.S. parent by the end of 2009. Rationale used by the JTA, the TRTB concluded that without a study, agreement, or contract, an invoice was issued as a price adjustment for the purpose of transferring income and receiving tax benefits. In the light of email communications between the U.S. parent and Japanese subsidiary, the Japanese subsidiary should be subject to fraud penalties of 35% under the administrative guidelines on fraud penalties. Acts of falsification and concealment are not limited to those of the Japanese taxpayers themselves. In this case, it was considered to be falsification on the part of the U.S. parent. Defense tactics used by taxpayer. The taxpayer argued that if the examiners considered all of the factual background, the examiner must conclude that the payment was not a donation. Instead, it was a transfer pricing adjustment on reasonable grounds for transfer pricing purposes. After many months of discussions with JTA, the examiner finally accepted that the adjustment was made for transfer pricing purposes. However, the examiners argued that the liability was not fixed at the end of 2009. The U.S. parent and the Japanese subsidiary had not agreed on transfer pricing adjustment under the criteria for fixing liabilities under corporate tax law. The taxpayer agreed to amend its tax returns. The taxpayer revised its earlier transfer pricing adjustment and deducted the transfer pricing adjustment in the year of corporate examination. As a result, the TP adjustment was deducted after intercompany agreement, which included a clause for TP adjustment, was executed. The Japanese subsidiary was subject to 10 or 15% penalty and interest tax, but not subject to additional tax. Donation taxation, which is a permanent difference, can be resolved by being treated as a timing difference. Recommendations. Intercompany agreements should include a clause allowing for transfer pricing adjustments. The taxpayer and foreign affiliate should have transfer pricing documentation in place that justifies the interquartile range before a transfer pricing adjustment is computed to place the target operating margin within the range. The company's transfer pricing policy should stipulate the TP adjustment computation methodologies, such as targeting a median. Other comments. Donation treatment is imposed by corporate examiners, not transfer pricing examiners. The Japanese tax authorities examine corporate taxpayers every 3 to 5 years, but undertake transfer pricing examinations when they suspect that there could be transfer pricing issues. Thus, donation treatment has been imposed more often than transfer pricing adjustments. Effective from January 2013, the Japanese tax guidelines were amended to allow the Japanese tax authorities to undertake corporate examinations and transfer pricing examinations simultaneously as one examination. As a result, corporate tax examiners gather transfer pricing information from taxpayer. They pass this information along to TP examination specialist within the tax bureau to determine whether a transfer pricing problem exists. Corporate tax examiners do not have sufficient technical expertise to conduct transfer pricing examinations, but they can determine whether an intercompany agreement and transfer pricing documentation existed prior to transfer pricing adjustments. Because of this, the risk of donation treatment has increased. Donation treatment is imposed on the basis that a taxpayer has given away a benefit for nothing. In other words, taxpayer has donated the value of a good or service. The deduction for the donated amount is disallowed by the tax authorities. Unlike transfer pricing, examiners do not need a technical basis for disallowing donation. The fact that there was a donation is sufficient. In addition, donation taxation is imposed under Japanese domestic law. Moreover, taxpayers voluntarily amend their tax returns to reverse the deduction. The JTA does not issue an assessment notice imposing additional taxation as a result of the disallowance of the deduction. As a result, the Japanese Mutual Agreement Procedure Office may not accept a MAP application protesting donation treatment. I included the relevant rules and laws in the following pages, but I will skip. And so let me turn back to John.
Thank you very much. I think it's very clear that we have to take particularly year-end adjustments very seriously. This donation assertion is certainly threatening. And there's also, of course, the thought that if the taxpayer makes a downward adjustment, and which is, of course, a reduction in Japanese corporate profit, then that would suggest that the transfer prices through the course of the year have been too low, and there may be some indirect tax consequences as well. So I think that's a very salutary learning. And I think then we can move on, Yoshiko, to case study 3, the revocation of blue return approval.
Thank you, John. Case study 3, revocation of blue return approval. What is blue return system? By fulfilling certain conditions related to bookkeeping method and the proper hard copy storage of books, invoices, receipts, etc., the taxpayer can receive various tax benefits. Taxpayers that fulfill these conditions may submit a blue tax return. Hard copy storage near the taxpayer's main Japan office or their offices of all books and records is generally required. A taxpayer may apply for permission to store its book electronically under the Electronic Book Maintenance Act, the Act. However, if a taxpayer uses electronic storage without approval, the electronically stored records will not be recognized, and the taxpayer will be required to maintain hard copy storage. Revocation of blue return benefits. Failure to fulfill the requirements for blue return can result in retroactive revocation of various tax benefits, carryover of losses, special depreciation, various exemptions. Some taxpayers have had loss carryover of billions of yen. Retroactive revocation of their blue return status would result in an immense tax burden, including penalties. Transfer pricing audits and revocation of blue return approval. In the past, tax examiners were willing to overlook the issue even when taxpayers did not apply for approval based on the Act and did not store hard copies of books, receipts, etc. However, in the last year, requirements during transfer pricing audits to seek books, receipts, etc. in hard copy rather than on PC screens have been increasing. There have also been many warnings that if hard copies are not stored, the right to file blue return will be revoked. Reasons for the change in attitude may include: 1. Over 16 years have passed since the enactment of the Act. 2. The General Act of National Taxes was recently revised. Tax authorities' tax audit procedure have become more strict, and various restraints at tax audit have increased. And it is difficult for the tax authorities to obtain segmented information on foreign-related parties, like parent company, as well as Japanese tested party. While this is not related to the taxpayer's blue return status, it appears that the revocation of blue return approval is being used as a threat in transfer pricing audits. Countermeasures. As the conditions for filing blue returns are objective, formal requirements, there is no room for interpretation. The tax authorities can easily revoke blue return approval based solely on the fact that taxpayer has not stored its records as hard copies. As over 16 years have passed since the enactment of the Act, it is not unusual that it is being more strictly enforced. As a result, it is necessary for companies that wish to store documents electronically to apply for permission under the Act. There are various electronic storage methods, and methods for different types of books, documents, etc. are specifically regulated under the Act. Therefore, it is recommended that taxpayers seek professional advice regarding the correct storage methods. Let me turn to John.
Thank you very much. And it reminds me of yesterday. I was playing tennis with my kids, and I can hit a really good tennis serve in. I can ace them, but if my foot is on the line, it's a fault, and it doesn't count. You can't commit these foot faults in Japan. It's just too risky. And so I think it's another environmental consideration that we have to take into account when we're thinking about responding to these challenges in Japan. Now, with all of that, let's try and change the pace a little bit and change the flavor a little bit by moving to my colleague Keith Thomas, who is going to walk us through some practical advice on how we handle or how we advise the handling of audit risk. Keith, over to you. Thanks.
Sure. Thanks, John. So in this section, I would like to provide a step-by-step guide to help you as either the Japan regional or global tax director wondering how best to be prepared for a TP audit. I've broken down this section of the presentation into 4 steps. So step 1, what to do prior to the TP audit. Step 2, at the start of the TP audit. Step 3, during the TP audit. And finally, step 4, what actions should be taken post-completion of the TP audit. Okay. So as Carl's case study illustrated, good quality TP documentation is crucial. Unlike, for example, the US, there is no penalty protection. And in general, a key point for TP documentation is putting the company on the front foot in the event of that TP audit. Key to good quality documentation is conducting interviews locally and not relying on presumed fact patterns. It is important that the whole team is involved, global, regional and local, so that local facts are sought and then presented consistently to other countries' TP documentation. we would like to mention that local ownership of the TP documentation is very important. The person on the ground needs to understand the facts and be able to face the questions of the TP auditor. To this extent, we would suggest investing in the TP training of the Japan tax director. The process of creating TP documentation is also important, and understanding your strengths and weaknesses should there be an audit is key to constructing strong TP documentation. Sometimes we find that some of the thinking behind how the TP documentation was constructed is lost over time, for example due to turnover of staff. The statute of limitation in Japan is 6 years of transfer pricing. Given this potential time lag, the person taking over may not understand why certain positions were taken or why functions and risks were phrased in a particular way. In addition, there are items which may not fit well in the TP documentation report. However, in case asked about in an audit, it would be good to have the evidence or arguments ready to be able to provide to the tax authorities promptly. It is good practice to keep memos or materials that explain the additional points that supplement the TP documentation. In addition to the main report, documentation report, backup documentation is very important in Japan. By backup documentation, I mean the documents and records a company would be expected to have in the normal course of business aside from the TP documentation report. Examiners in Japan will verify that the information contained within the TP documentation report is consistent with the other documents and records held, including the relevant intercompany agreements, TP policy documents, invoices, etc. As Yoshiko mentioned in case study 2, it's important to ensure, for example, that the details of TP adjustments are made clear within the backup documentation. Another area where backup evidence is often requested is for the benefits of intercompany services. It is important that a company can demonstrate that the intercompany charges have been agreed, that there is a commercial benefit to the local entity for those services, and when ultimately invoiced, the invoice can be used to explain what services have actually been charged for. Under each step, we have set out at a high level some areas where it is possible to make use of your local tax advisor. For step 1, the first item is the preparation of the local TP documentation in coordination with your team. The second is a review of the existing TP report and backup documentation for potential TP risks if there is an audit. The local advisor, based on their past experience, will be able to point out risk areas and how to make improvements. In addition to helping you with the coordination or drafting the main TP documentation report, your local advisor may be able to assist with some of the backup documentation, such as drafting or commenting on the draft of the intercompany agreement. Step 2 in our step-by-step guide is the start of the audit. This is the point you learn that there will be a TP audit commencing soon. Our first recommendation is to focus efforts up front. Often the initial questions may seem straightforward and there is a temptation to provide materials quickly without detailed review or explanation, for example due to time and resource constraints in responding to the likely many requests at the start of an audit. However, the longer the audit goes on, the harder it is for the auditor to walk away without any adjustment, and therefore upfront investments can pay dividends later. Our suggestions for preparation are as follows. Understand the audit team. Even if the audit is a corporate tax audit, look to see if any of the team members has TP experience in their background. Confirm the years to be reviewed by the TP audit team and find your TP documentation and backup files relevant to this period. And this is a good time to remind yourself of the conversations hopefully you earlier had about the strengths and weaknesses of your documentation and set out a strategy for responding to the audit. In order to be able to work hard up front, it's important to have the people in place. Additional team members should be assigned if needed. In order to help determine the resource needed, we suggest that you discuss the timetable upfront and often throughout the audit with the tax authorities. Again, we have put down a few possible areas where the local advisor can add value. These are reviewing the background of the audit team members, providing a review of TP documentation and/or backup documents, and helping you determine the strategy for a TP audit response. In part 3, we have put down some recommendations to help during the audit. So number 1, don't be afraid to clarify the auditor's questions or requests for information. Sometimes the intention is not clear or the question may not fit your business. In those circumstances, it may be helpful to the auditor to get to the heart of what they would like to ask and explain what is relevant for your industry or for your business. If you are not sure of an answer, rather than guess, don't be afraid to defer your response, informing the auditor that you will check. Having said that, not responding to all questions is not ideal, and in addition, it is important to follow up and obtain the information and submit promptly afterwards. Auditors sometimes ask for you to make estimates in meetings, but please be careful when providing, as those estimates may still be used as evidence by the tax authorities, and it may be awkward if you need to significantly change your estimate later. It is often tempting to hand in lots of information to respond quickly, but this may actually slow things down because potentially it will take time for the authorities to understand and review the heavy amounts of information, and they may miss key points. In addition, it is important to review items being submitted for the potential to be used as evidence for a point that was not in the question. As an additional note, we have experience of a corporate tax audit becoming a TP audit due to the materials supplied. In a TP audit, the role of the functional interview can be key. First point to note is that on occasion, the tax authorities may ask for an interview without advance notice. We would recommend that this is resisted politely by explaining the person is busy and set an appointment with the tax authorities subsequently. During the time before the interview, it's essential the person is prepped, making them aware of overall strategy for the audit, informing them of the items submitted, including TP documentation, to help them align their responses and avoid misunderstandings or misperceptions of inconsistency. During the audit, it is important that the global and regional team stays involved. Regional and global has an important role in reviewing items and supporting key decisions given the implications outside of Japan and for the future TP position in Japan. I'd like to give you an example of a key decision. In Japan, it is often possible to negotiate a lower assessment through an amended tax return. This means admitting error and revising the tax return yourself. The alternative is insisting that tax authorities make a formal assessment which may be higher in amount, though unlike the amended tax return, the taxpayer maintains the right to file a claim through mutual agreement procedures. For step 3, the areas the local advisor can help with are joining the meetings with the tax authorities to help with the responses and to interpret how the audit is progressing. In addition, local advisors can review materials to be submitted, prepare rebuttal papers on material matters, and provide advice on the negotiations. Apologies, I didn't forward the slide. So last step is step 4. Assuming you have been issued with the correct notice, rather than choosing to file an amended tax return, you can choose to file for mutual agreement procedures or make use of domestic procedures. In addition, as mentioned, you'll need to deal with the practical matters such as revising the tax return. Other points apart from procedural are how to share the information gained from the audit and the outcomes of the audit. It's good practice to hold a debrief on how the audit went and the results. One thing to consider is sharing the results with non-tax stakeholders, including senior management and, for example, the functional interviewees. Finally, it's good to set out the key findings from the audit so that the next team who handles the audit has all the insights from the past. Finally, for step 4, areas your local advisor could potentially help with are the claim for mutual agreement procedures or domestic procedures, supporting the debrief, and, for example, creating presentations for key stakeholders. With that, I hand back to you, John.
Thank you, Keith. That's very useful. Just before we move to the final polling question, we do have a couple of questions that have come in from participants. And I'm going to ask Carl and you, Keith, to take these questions. The first one, I think we touched on the point at the end of Yoshiko's section there, and that is, can we, the taxpayer, make a downward year-end transfer pricing adjustment for tangible goods without impacting customs duty, providing, of course, we have the appropriate documentation in place? Can you take that one first?
Sure. So so this is Carl. Anytime there is a transfer pricing adjustment which reduces Japanese income, in other words, it raises the import price, and since we're talking about year-end adjustments, this is retroactive to the prior parts of the year, or retroactive back to the start of the year. There are customs risks. There's also a risk related to import consumption tax. So even if your products are not dutiable, there would be a question around the import consumption tax, and should that be revised? And there are different ways of handling these risks. One way is to go back and revise your filings, but that can be very time-consuming and burdensome because those taxes are generally levied on a transaction-by-transaction basis. So you have to figure out how you would apportion a year-end adjustment amount to all of your import transactions for the year. There are companies who do that. There are also ways to negotiate with the customs authority in advance about adjustment mechanisms to try to sort of save on the burden of going back and revising everything. So that's something I'm happy actually to connect the questioner with someone from our customs team for more detail on that matter.
Thank you. Thanks, Carl. That makes sense. I think that is the right way forward. And then finally, just one other question here about language requirements. Is English only acceptable? And for example, interviews which are conducted, Keith, you've been talking about those. If, for example, foreign executives or managers are working there, are the interviews conducted in English, or is everything in Japanese? Just a thumbnail. It will differ, I guess, by case. But what do you think about that, please?
Sure, John. This is Keith. So just a quick response on that one. So in general, the language requirements, according to the guidelines, are Japanese. Having said this, there's quite a lot of variation between the different auditors about the acceptability of English. So for a lot of companies, they prepare their documentation in English. During an audit, they will often submit documents such as intercompany agreements, etc., in English, and then maybe translate parts, in particularly important parts, for the auditor as required. Just a quick note on the interviews. So interviews are in Japanese, but they can be interpreted. So we would encourage non-Japanese also speaking people to also take part. And yeah, this is sometimes very positive. The tax authorities want the person with the most relevant knowledge in the room.
Okay, thank you, Keith. Right, we just have a minute left, and so I've popped up the final polling question. Remember, if you answer this and have answered the previous ones and have been with us for the whole of the webcast, you can claim your CPE credits. So, would you mind clicking, please? This is a single answer. When do you expect your next TP audit in Japan? Next week? Oh, I hope not. Within a few months, next year, or in 2 to 3 years? Please click away there. And as we wait for the results, which I will push just now, there we have a few people thinking they're more than a few, 84%, thinking that it might be 2 to 3 years, and only about 15% or 16% thinking next year. Well, we hope you're right. It would be good to think that this thing is not imminent, but I think if I had to sum up what I've heard, I think it is a fairly hostile environment. Localization is imperative, and you can't always rely, in fact rarely can you rely on just the global story. And it seems like the investment in localizing upfront is can be a very good investment. The modest incremental effort, you get accretive value of substantial proportions. You can help avoid some of the difficult things that we've been hearing go on in Japan, from Pamela, from Carl in this case study, and from Yoshiko in some of the idiosyncrasies of the Japanese system. I think in concluding, I think this sounds like it's the kind of thing where I'd be thinking, well, maybe I should have a health check. None of us like going to health checks with medical professionals, do they? But they have the ability to give us an early warning, to give us some degree of prevention, even if it's some housekeeping or lifestyle changes. And if it's more than that and the diagnosis is not great, then of course you have to decide what the best course of remedial action is. Is that to fight for no adjustment? Is it, as we've heard, possibly to amend the return? Is it to fight and insist on the issuance of an assessment? And then after all of that, what redress do I have and how do I best harness, for example, mutual agreement procedures with the counterparty tax authority? So all very good advice, I think, from my colleagues in Japan. We encourage you to take it. We thank you for taking time out of a very busy day. We hope you'll join us on future webcasts, and please look out for the on-demand version of this appearing over the next few days. With that, let me thank my colleagues in Tokyo for a very educational webcast, one that's given me pause for thought, and as I talk to my European clients, this will be factoring in those conversations. Thank you all. Enjoy the rest of your day, and we hope to hear you and speak to all of you again soon on another webcast. Thank you.